Glenn Sandala to talk about how things have moved for Glenmark Pharma for the quarter gone by. Glenn, good morning. Thank you for joining us. Before we get into specifics, why don't you outline the quarter gone by for us in terms of the mainstay, the pricing power, and what happened to our mother market, which is the US market?
Well, I think overall it's been a decent quarter for us. We've grown top line revenues at about 16%. The US business, we've seen some strong growth coming out of some of the launches, India. So we've seen across all our markets pretty strong growth. Our EBITDA margins continue to be at about 17+%. And we had a one-time hit on account of currency, and overall net profits also grew despite the currency hit. So I think all in all a decent quarter.
Is there a relief on the US generic front? Are you getting a sense that pricing pressure, if they have not improved, at least pricing pressure has stopped contracting?
Well, we are still seeing pricing pressure. They have come off a little bit. So right now the price declines are about in the 8-10% range. They were much higher, from last quarter. So they've started to retract a little bit.
Just going through some of the notes after your earnings, and Citi Research is saying that Glenmark's US revenue has been sluggish over the last few years with delays in approvals for key products. What is it that you're doing at your end for the company to improve execution as well as approvals in the US?
So if you look at the approvals, I mean, we've got a reasonably good number of approvals. I think we're up to about 15-17 approvals this year. So it's a pretty decent number. As far as execution goes, we're able to get decent market share, 20-30% market share on most of the products that we sell. Of course, the overall pricing environment on the base portfolio continues to erode. And that's what's impacting the overall growth. So I think going forward, it's just the new product launches which will continue to drive the growth.
Hi there, morning Glenn. Just wanted to get in a sense as to what the outlook is going forward on your growth, because we had the recent JP Morgan conference, and I believe the company said that over the next few years, over the next 3 years or so, growth is going to be driven by the launch of the specialty products. So does that mean that your spends in R&D are going to increase?
So I think on the specialty side, we bought a small portfolio from a company called Exeltis and of derm products, and we have 2 other product launches going on the derm side. So in FY20, the specialty portfolio should start contributing to the overall revenues, both in the derm segment and in the respiratory segment. We have Ryaltris launching. So FY20, besides the generic growth, the specialty business should kick in and start contributing quite significantly. As far as R&D spends go, we continue to spend close to about 13% of total revenues on R&D, and that includes innovative R&D. And as you probably read, we are now looking at spinning out our innovative R&D into a US company. So, but all in all, we spend about 13% across the board in R&D.
You have a strong presence and brand recall in India in dermatology, respiratory, as well as cardiac, etc. Are you looking at expanding your OTC business where brand recall is high? Is that the strategy?
Well, as a company, strategically, we focus heavily on derm, respiratory, and in India, cardiovascular and metabolic, and oncology. These are the 5 segments where we are pretty dominant as a company, particularly in India. The OTC segment, our strategy in OTC is basically RX to OTC switches that we do, which has worked pretty well for us. We're up to about 200 crores in sales on 3 OTC brands that we sell. And I think going forward, the OTC segment should continue to see strong growth and further scaling up of this franchise.
You know, your ANDA for generic Renegal, just wanted to understand what is the size of opportunity and will it be a high margin product now that you've got the approval for it?
So that's about $120 million market, and right now it's just us and the authorized generic, so we should be able to get some decent market share on the product. So it should be a good product for us. Again, a lot will depend on how many more competitors get approved in what time frame, but as we speak, it's a pretty good product with high margins and decent market share that we've been able to pick up.
Market share and high margin product, could you just quantify that?
Well, it's very hard to give you a number.
What would be your guidance on your debt reduction? That's something which has been of immense market curiosity. I mean, something which, I'll be very frank if I say that, which has been of market concern also.
Well, I think, look, I mean, every year this year last year we did a good job in reducing debt. This year again, we will reduce debt compared to where we were last year. So I think every year we will continue to bring down the leverage. At this point, you know, we are about 1.5, next year we're between somewhere like 1.5 times EBITDA. You know, we'll be comfortable with those kind of debt levels going forward.
To reduce debt, your cash flows have to improve, or you have to look at monetizing some of your non-core assets, or you'll have to, you know, bet on some degree of pricing power. What could be the key differentiator for you? Do you think prices will improve, or would you be monetizing a lot of non-core assets which where you invested in, now it does not make sense for you?
Well, I think if you see, we did some amount of monetization with our ortho franchise, right, in India, where we bought True North as a partner this year. In addition, I think we continue to work on various cost-cutting initiatives which will drive our margins and improve the cash flows from the business. So I think clearly we are looking at operating efficiencies, driving the business going forward.
You know, right now there is this Ayushman insurance scheme which has been a successful rollout. That will change the way how healthcare cost in India will be calculated. If Ayushman scheme becomes more popular, could that have an impact on India portfolio for companies, or, you know, for the Indian pharma companies per se?
Well, our view is, I think the whole Ayushman scheme is positive for the industry because it brings another lever of growth for the industry.
So in terms of pricing challenge, you don't think there could be a serious pricing challenge, at least in the domestic business, for you and for others?
But I think near term the branded business in India is pretty solid for all Indian companies. So we don't see a big shift happening from this.
Just to get closing comments on what we understand on the API market. We understand that within the API market, the Chinese API market, the dynamics have changed there. How will that change, and how will that help a company like Glenmark?
Well, I think in FY19 we saw an increase in API costs coming out of China. FY20 we think there will be some easing. We've started to see some easing in terms of the cost of API coming out of China. So I think from that perspective, margins will get better on account of lower cost of goods from here on, particularly in FY20.
Okay. Well, Glenn, appreciate your time, and thank you for joining us, and certainly hope to see much more of you going forward.
Thank you.